Well, we've just taken a comparison of the top 5 EMS companies who already reported the results. And for Dixon specifically, it seems like, the mobile margins will expire after this year. So FY27 will be a year, first time where there will be no PLI margins, and hence that's the impact. We've just taken the company's revenue growth as well as profit growth, what's been in this particular quarter, and just given the standalone margins for the companies in this particular quarter. And we'll get to that in a bit. In terms of revenue, Dixon, of course, leads the way, 221% essentially that they've grown in this particular time frame. The revenue has been led by the growth in the mobile business, but because of that, the margins are the lowest amongst the peers. But the growth over the last 3 to 4 years in the revenue growth has been the highest, and there is the rewarding. We'll get to the valuations as well. That is given to Dixon in terms of the revenue. In terms of the other players, such as Kaynes Technology has been one of the biggest gainers, and that's largely because of industrial as well as the auto business for the company. And for PG Electroplast as well as another gainer, that's also because of the TV business that the company has, as well as the products business that the company has gotten into. I just want to just switch to the PAT growth first. That's largely been very positive as well for something like a PG Electroplast, over 100% growth in terms of profits for the company in this particular quarter. They've also raised their guidance for over 30% growth next year as well. While someone like a Syrma has been lowering their share for the consumer business, and that's helped the profits grow at 87%. The key reasons for giving standalone margins and not the growth has been because of the trajectory where these companies are moving on. Now for Dixon, they are a low margin business because they largely have roughly 85% of revenues coming from the mobile vertical, and that's a low margin business because of lower share of ODM or own design, basically, which is a higher margin pressure. For someone like a Kaynes Technologies, they get almost 55% revenue from the industrial vertical, which has smart meters as well as their own designs, where the company can control more margins, and hence we've seen the valuation also getting rewarded for the company. And the last one I want to mention is Amber Enterprises, another consumer-focused company, largely focuses on air conditioner manufacturing. That's roughly 50% of the company's revenues, lower from roughly 75 that it used to be. But again, they're now getting into the electronic business, and this margins will be improving going forward as well. In terms of guidance is the second key part. Before valuations, I want to get into. For Dixon, they've said that the smartphone business will grow more 53% from the FY25 level. They will be selling roughly 4.6 to 4.7 crore smartphones in FY26. That's roughly 1/3 of the market currently of India. When you look at something like Kaynes Technologies as well, expecting a 60% revenue growth in FY26. For Amber as well, they're expecting 10 to 12% growth above industry average. And for the industry, for the AC industry, the growth has been 25%. For PG Electroplast as well as Syrma, PG has again guided for 30% revenue growth at a year where the revenue has grown almost 60% in FY25. So building on the growth momentum. And finally, for Syrma as well, management guiding for 30 to 35% revenue growth. They've also mentioned an EBITDA margins of 8%, which will be a key positive because they're currently somewhere around 6.5% now. And finally, in terms of valuation, here is where it gets slightly tricky because, at one end for FY27, we've seen something like a Dixon trade at 80 times price to earnings. Kaynes has just taken the baton of being the most expensive EMS stocks, and that's largely because of the industrial vertical for the company. At 52 times, Amber offers a very interesting opportunity for investors where the growth is consistent at 30%. The metrics on returns are also very positive. And finally, very interestingly on Syrma, the cheapest stock in the EMS space, growth consistent at 30 to 35%. And that's going to be one of the most interesting ones to watch out for going forward because they're lowering the consumer share, increasing the EBITDA margins. And hence, these are the 5 key EMS players you should be on a watch out for the next couple of years. Commentary as well as the new PLI component scheme is another key beneficiary on top of that.